Bro, where everything's good with you and your family.
Thanks, brother. You too. Everything's great.
Same here, bro. It's good to hear.
Amazing. God bless.
God bless, bro. Oh, man.
Oh, happy St. Patty's Day.
Facts. Happy St. Patrick to you too, bro. Yo, you see gold, bro. Cheese! Things back almost at 2K. That's crazy, bro. That's really interesting to see. It came back to 2K. Gold, like always, outpacing fiat currencies.
Oh, that speed.
Call that speed, bro. They wanted, yo. It's crazy. I'm gonna talk about gold though. I'm gonna talk about a lot of the other currencies today. Gold, like gold euro, gold pound, gold Swissy, gold CAD. Like those have been outperforming like tremendously over the last couple of years. I'm gonna talk about that a little later. But like since I got everybody in, we're just gonna get right into it. This is gonna be a short one. I want to rest. It's gonna be an hour. So probably just gonna. I might push it over to an hour because I know myself. Um, but yeah, we're just gonna jump right into it. Since I have everyone's focus now, I'm gonna jump right into IPTA and open float. So currently DXY took out 20-day high, 40-day high, and the 60-day high. So we took out a lot of orders above this high here. Now earlier, I did say that I saw December as accumulation, January as manipulation, and February as distribution. So it looks like we may have been coming to the end of that distribution cycle. So we got back to this high here. So I had a post on TradingView. I'm not gonna go look for it, but I had an eye above here saying that this was going to be a potential reach for the dollar in the future, and it finally got there. Now we got there. We took out all the buy side liquidity that was above there because everybody that was going short here most likely has a stop loss above here. Am I recording? Yes. Okay. Has a stop loss above here. So it comes back, takes out the buy side. From that day, we took out that buy side. Ever since that day, we ran up and took out all, and we did it in 2 days, honestly. We did it on March 7th, and we did it here on March 8th. So it only took 2 days for them to bring price back up, take out buy side here, here, and here. Now what do we have left? So we have sell side that's all the way down here, and we have an old low here, and we have an old low here. So you can see how price is coming back down to that old 60-day low. It's getting close to it. So it came down to it, ran away. It came down to it, ran away. And now it's coming back down. We recently have a breaker, a bearish breaker, and you'll see this on GU as well. So we see price has a high point, comes down, makes a low, and then runs higher. So there's two highs here, and we're going to find the last down close candle before the rally up. So the lowest one here, it's this one. I'm going with the largest one with the largest body, and we draw this out in price. So that's your ICT breaker, right? So price has a high here and high here. You look for the lowest point here. That candle here, we're using the entire range, just like ICT suggested us to. The wick high and the wick low. We draw the whole candle out, and you can see how price comes down, comes up, and look at the response. Almost perfect, too. Fills it to the top of that candle, and then drops quickly to the downside. So it looks to me that dollar is shifting back bearish. Now, for me personally, overall, long term, this is just my personal thoughts on this. I think dollar will make a comeback. I don't know when, but I still foresee dollar being strong. It may not be next month. It may not be the next 2 months. It may not be the next 3 months. But I know sometime in the future, the dollar is going to come back like it always does. Dollar tends to outperform all the currencies long term. The other foreign currencies like pound, yen, euro, New Zealand dollar, Swiss, CAD, yen, yuan, those currencies, Aussie, those currencies don't tend to outperform the dollar. That's just statistics. You can look up. But price comes down, comes up, runs buy side, and it's coming back down, runs back into the breaker. We can see now we're getting a reaction away from it. So now, where would I suggest price most likely to go? Probably down to this old low. That would be the next target for the DXY. And then potentially these clean lows here. Because anytime you see clean lows, most likely retail is going to play it as some type of what? Support area. Because retail's probably think, oh, dollar's going to come up, come here, go higher. So they draw a little fancy little support box here, which doesn't make any sense, and we know that's going to fail through. It's going to cut right through the candle, cut through their zone, and cut through these lows. If price is chasing sell side liquidity, it's going to take out swing lows or old lows. That's where the liquidity is residing. It's not residing in the middle of the candle or at the high or the open of the candle. It's residing below the lows. That's where sell side is. The same reason we ran just the highs here. Look at how it's almost like perfect. Because some people may say, oh, the market's random. We know it's not random. We know it's methodical, and we know it's strategic. Look at how they run the high. Odds are they could have ran this too if they wanted it to, but it looks like they booked enough orders to turn price back around. But you can see how they just run these highs just by a little bit. All these highs here, they just run it by a little bit. This one here, this one here, this one, just by a little bit. And then they say, oh, yep, we're gone now. Turns around on a dime. Doesn't allow anybody to get in short unless you've been expecting a selling opportunity there. Oh, stop that. Unless you were expecting a selling opportunity here. And like we said, IPTA can help paint the storyline to catch these turning points in the market. Like I've showed over the months and over the years, or over TradingView, and now on YouTube, you can see that IPTA just allows you to see where large orders are residing. That's it. People make it a lot complicated. But if you go back and watch ICT's video, I'm not sure if it's I don't know if it's month 5. If you really need the video, I'll definitely find the video and give you the link so you guys can watch it. It's almost like a 3-hour video. I know it's really long. Don't skip through it. But in that one video, ICT really sums up a big bulk of the thought process of what IPTA is and why the algorithm is using specifically 20, 40, and 60 days. It's algorithmic. It's all computer coded. It's not a human being sitting down at a computer and saying, okay, we need to go get in and sponsor buy side liquidity so then we can then sell, and then sponsor sell side and then we can then buy. No, it's not like that anymore. It's all algorithmic. It's all computer based. It's coded. And these people that coded the market, right, and made foreign exchange, made stocks, made commodities, made future more of a AI futuristic thing, right? They needed a basis point. They need a turning point. Someone needed to code the market and say, okay, if this market is coded, it's going to go based off of a specific day or a specific period of time. And that's what ICT has exposed us to. He's saying that the market has been coded to use certain increments of time, and it's normally 20-day increments. Every 20 days, the market is looking for a new liquidity pool. If not, it's most likely going to consolidate. If it doesn't find a new liquidity pool in the next 20 days, odds are it was just consolidating. As you can see, from March 1st, 20 days forward, it found what? Buy side liquidity pool, right up here. That's not random. Now, after taking buy side, we can only speculate that it's going to go lower. And like I said, these are clean lows down here. You even have a fair value gap here, a busy, buy side imbalance, sell side inefficiency. So we'll just mark that out briefly. We have that there. Could price come back down into this and dig deeper into this? Because it already has tapped it. Doesn't mean it doesn't have to come back into this zone. It can. And it could probably finally come back and fill it all the way in. You also have a volume imbalance here. I don't want to mark out every single PD array because I want the chart to be clean. See that gap between the candles? There's a space in between it. That's the volume imbalance. That's just another PD array, another inefficiency in the marketplace. Right? The algorithm doesn't like that. If we can get, I guess I'm not going to get it. If you could get this to show. Just want to show people. That's the volume imbalance right there. That's another PD array. I didn't make it. ICT did. Not taking ownership or claimage to this. Honors to ICT. Volume imbalance. And then you have the IPTA lows. Sell side liquidity. There's people that made bank down here, right? Because it made a turning point. It dropped below February's opening price, and then it rallied up all the way through February. So that means there was some institution, some entity in the marketplace that sponsored a buy down here. Now we know that there's the commercial speculator. There's three speculators in the marketplace: commercial speculators, large speculators, and small speculators. Small speculators are me and you, and everybody else in the retail world. People that have small to little liquidity. As much as people may say, "Oh, I have a funded account of 200,000 or 500,000, or I have a live account of this much." Trust and believe there's someone out there with a bigger equity than you. There's a bigger fish to fry. And the larger we go up the pyramid scheme, right? If we go up a ladder in the pyramid from small speculators and we go up, we have large specs. So we have large funds. And these large funds are also trading. But then we have the commercial speculators, and the commercial speculators are trying to offset the large funds. So those large funds that might have went long here, they're trying to offset them somehow and get them out their positions. They're not worried about small speculators. I want you to understand, they're not hunting your stop loss. They're not targeting your stop loss. You're just in the way. That's it. You're just in the way. You're a tiny speck in this liquidity pool. You're nobody. Nobody special in this market, especially if you're retail. Large speculators happen to be a little more important because the commercial speculators are trying to offset them. Whether it is reaccumulation, whether it's offset distribution or redistribution or reaccumulation, they're trying to offset orders. And they're just playing back and forth, tit for tat. Just playing with themselves back and forth because they need to sponsor the buys and they need to sponsor the sells. Once you understand that, you understand these markets are not random. It's not just going up and down for no reason. It's methodical. It's strategic. It's time sensitive as well. Now, I know some people may ask, if the 20 day, the exact day on 20 day, ICT has said that in this video. It's not that the 20 day may be influential. It's that around this period, there might be a new leg if it hasn't taken out a liquidity pool. There may be a nice reaction here, 20 days. And then 40 days, so let's say if we go over 40 days as well. If I could find here and measure out 40 days. This magnet thing. Here to here. That's another 20-day period. Something's going to occur here. We all know it. I mean, it's not rocket science. We know that the markets are not just going to stall sideways forever. We know it's going to accumulate orders. It's going to attack one side of the market and then run to the other side. It's going to make its money on one side, clock in, and then go back home. That's what it's doing. It left work, ran all the way up here, made its money up here, and it's probably trying to go back home to where it came from. That's how I see it, at least, in that analogy, if that makes sense. But every 20 days, the market is doing something. And you can see here, this 20 day, there's something going on. We got that breaker. We have this busy, volume imbalance, and then swing lows. So could dollar come down here and reach lower? Yes. That is something now I'm factoring in. Because before that, I was not factoring in a lower dollar. Right? Because of the rate decision with ECB, with other central banks, increasing their rates, and a lot of the funds going on in the bank sector, things are running dry. So things are looking skeptical. People are trying to put their money in other places than the dollar. Even though it is the reserve currency, there is still a lot of investors worried about what's going on with the U.S. economy and what's going on with the dollar. So what is going to happen? Gold is going to go crazy. Bitcoin is going to go crazy. The stock market is going to go crazy. Risk assets are going to be back on top because investors are like, okay, instead of putting my money back into fiat currency, let's get back into risk assets like gold, silver, copper, Bitcoin, crypto, ETH, whatever it is, and stocks and etc. That's what's going to occur here. So once people see dollar getting weak, you're going to see stocks start to rally. Not to say it's always perfectly correlated because there are times where dollar rallies and stocks rally. And there's times when dollar rallies and gold rallies together. We know that there's time periods like that. We could go on the monthly chart and view that. We can see that there's plenty of months where dollar's going up and gold is going up at the exact same time. And people are going to say, oh, but I thought they were inversely correlated. There are periods of time when that does happen. Investors are going to put their money into risk assets that are going to probably compound them or give them a great rate of return. And it's going to most likely be gold. And we'll talk about that later at the end of the video. I really want to show you guys something with gold that has been really profound and like astonishing to me. Like you'll see at the end. But every 20 days, new liquidity pool. So let's come down to GU. The fact that we know GU, British pound versus US dollar, is inverse because it's GU. The base currency is British pound, and the quoted currency is US dollar. So when you're looking at the currency pairs, or any pair at all, the slash here, it's British pound to US dollars. It's not the other way around. It's not US dollars into British pound. The fact that this is first, it's the base currency, and anything after this slash or second is the quoted currency. As you can see, it is inversely mocking the dollar index. It came down, took out the 20-day low and a 40-day low. So these two liquidity pools have been taken out. And yes, it returned back down to the old 60-day low. It's already been broken by this low here. But these are unmitigated lows. They're not broken here and not here. It's sell-side liquidity. Everybody's asking, oh, why do you always use the monthly chart? Because ICT told me to. It's not that I specifically said, I just took his model and just ran with it. ICT instructed people to use the first of the month and then calculate your data points and then move it forward every single month. It's not that it's only 20, 40, 20, 20, 40, 60. It's actually 60, 60. If you watch the video, he's talking about a 60 range period, looking back 60 days and then looking forward 60 days. Deontay's preference is to use the first 20 days to get a quick trade. I'm trying to, what can I get a optimal trade off of reading price action on this data point, these data points here? It may not happen in the 20-day cast forward. It may happen in the 40-day cast forward though. It may happen on the 60-day. But you also would have to, I know it's a lot of work, you still would have to move your IPTA and keep in mind of the previous month's IPTA as well, because those levels are still important. It's not that these candles are not important anymore. Just because you're in another month does not mean prior data points are not important, especially if they're not broken. Sell side has been taken. We can see that we get a quick repricing to the upside. So we have that breaker. Let me remove the yearly open and March's open. You can see the confluence are dropping down into a discount below the monthly opening price. So they're buying, commercials are buying this cheap. They're not buying it expensive. They're most likely getting their bulk position below the opening price. It only makes sense. If you're a businessman or you're a business lady, you know you want to get the best price or the best deal possible. And if you're buying something, you want to buy it at a probably lower price. Not to say like you're cheap, like you're someone that's cheap and you don't like to spend money, but you would like to, probably get a discount. And that's what anybody would like, a discount off of something. Not to say it's less quality, but you want to get a discount on it. And that's what they're doing. They're bringing below March's opening price. Anything below the opening price here is discount. They bring the retail traders on the wrong side and boom, dynamic response up. Was I anticipating this myself, saying that GU was going to come back up higher? No, I was really not anticipating this. I was thinking that it takes out the sell side liquidity based off of the seasonal macros. And we'll jump into that real quick so that people don't say, I don't know what you're talking about. Incognito. Where are you at? That's the website there where I get my seasonal charts from. It doesn't matter. The one that's based off the S&P 500, it looks exactly the same as the one that says FX. I know that's going to be a question that someone's going to have. March, it said it was down, right? We did get that decline down, and then it starts to consolidate through. Like I said prior, January and February so far has been following the seasonal tendency. Not to say that this is always 100% accurate. It's just a treasure map. A treasure map is not always accurate. It gets you close to where the treasure is. It may lead you in the right location, but you may not get to the pinpoint specific coordinates of where the treasure is located. It may get you in that area, And you still might have to do a little more homework yourself. And that's what the seasonal charts are doing. It's not going to give you everything 100%. You have to do your homework. You have to line up other things. What's the COT data saying? What's the hedge program of the bank? What is the futures contract doing for British pound? It's not as simple as people make it seem. But if you really want to be accurate in getting a good read on price, you got to do your homework. It's got to be a top-down analysis. And for me at least, it starts with the macros. Seasonality first. It's the easiest thing to look up and find. Then I come down to the hedge program, which is based off of the COT data, not the weekly reports that are coming out. I'm not talking about the weekly reports. I'm talking about the COT data that you'll find on barchart.com. And I'll go through that as well to show you guys what I'm talking about. And then price action. Then monthly chart, weekly chart, daily chart, IPTA. That's it. That's my top-down. I literally, word for word, just gave you my top-down analysis on how I like to work the market. That's my personal approach. January was up, February was down, March was down, and it consolidates. As you can see, take this off. January up, just like the seasonal chart. February down, just like the seasonal chart. March said it was supposed to give a drastic drop down too. We're not getting that. So we see there's something coinciding with the seasonal chart. Something is not right. It's not following it. So if it's not following it, odds are it's probably bullish. It's not bearish, so then it's probably bullish. And we can see the breaker. Price comes up, makes a high point, then comes down. Where's your breaker? Oh, I'm sorry. This is the low point here, the 20-day low. Price comes up, makes this high point here, then comes lower and takes out that low. There goes your bullish breaker, your ICT bullish breaker. Two low points. What's the highest candle between these two low points here? This low here and this low here. The highest candle is this one here, the last up close. And we draw it out. We're using the entire range, like ICT said. We're using the high of the wick and the low of the wick, not just the bodies. We draw that all the way out. And I said in the daily updates that we could suspect possible retracements back down for GU. And it retraced back down into the breaker. And ever since retracing back down into the breaker, we're starting to see a reaction unfold and prices moving higher. You can also look at this as a swing high has been broken and now a higher swing low is forming. This is a swing low. 1, 2, 3. Because I have someone that DMs me and asks me, what is a swing low, Deontay? A swing low is simply a candle that has a higher low on the left and a higher low on the right. This is a swing low. 1, 2, 3. You can see this low is higher and this low is higher. And the candle in the middle is lower. So that's the swing low. This candle itself is a swing low. But the formation is a 3-bar pattern. 1, 2, 3. Same thing is occurring here for a swing high. Let's say we come to the high of this market. So just for obvious purposes, this one here is pretty obvious to see. 1, 2, 3. That's a swing high formation. This is the swing high. There's a lower high on the left and a lower high on the right. That's what a swing high is. So normally that's what the markets are gearing off of. A 3-bar pattern and then making a new move to transition either into probably reaccumulation or distribution or expansion. It's always going to start with the 3-bar pattern swing low. Swing low here, look at the new leg up. It all started with this here. 1, 2, 3. And now we're getting another potential higher swing low. We got 1, 2, 3. The third candle here has been broken, and if you know the ICT high probability scalp model, you know that if the third candle here is broken, the next candle here most likely is going to raid this high. Price action and the momentum is showing you it's bullish. I don't need an indicator to tell me what momentum is. The price action is telling me momentum is bullish because we're having a higher swing low. And the third candle in the swing low has been broken. This is the third candle right there. That's the third candle in the swing low broken by this candle's high. That means odds are, and you can check it yourself on Monday. It may happen on Monday, may happen on Tuesday. Odds are whatever next daily candles are going to form most likely is going to be a high probability run on this buy side liquidity above this high. And then price is most likely going to trend higher. And what is it going to reach for? Probably all these open float buy side liquidity above these highs. Too clean. It's too clean. And what has ICT told a lot of traders? Whenever you see clean highs and clean lows, they're most likely going to get swept with speed. Price is most likely going to be drawn to it because there's orders above it. There's stop orders above this high. Buy side liquidity. And price is going to run up, take out this swing high potentially. And whenever I see a swing high broken, I'm normally anticipating a pullback because price may liquidate orders above here, and then there may be some profit taking to offset the large funds again. Profit take, price comes back down, and then they make another swing low, and then it runs up higher. So if price were to come up here, take out this swing high here, I would suspect, not saying it would form, I would like to see another swing low form, a higher swing low form, and then another rocket ship leg up. That's what I would suspect. Doesn't mean it won't just go down and then just shoot right through and just keep having daily candles go up. But normally when you look at swing highs and swing lows broken, it normally gives another opportunity for the commercials to reposition either their net longs or net shorts. And you see it time and time again. Look at how this swing high, 1, 2, 3. This is a swing high here. 1, 2, 3. And I'll zoom in because I am blind myself, staring at the screen all day. 1, 2, 3. That's a swing high right here. That's been broken inside the potential breaker before it came back down. But that's a swing high. See how it's broken? What forms after this swing high is broken? A swing low. 1, 2, 3. They want this price action to most likely go higher. Let's just take a look at UJ naked. I want to always go through one together so that people can at least see how I'm doing it. Because I know it is better to see someone actually do it in front of you live instead of just seeing the chart markup. Let's bring this back. We already know dollar. We can see it's hindsight, but we already knew dollar was going down and British pound versus US dollar was going up. So UJ would be inverse British pound versus US dollar because the base currency is dollar. Deontay looks back 20 days. For those that have already sat through and watched this already, you know exactly what I'm talking about. I appreciate you guys for all the support. And I appreciate your guys' time. Time is valuable. And it all starts from this first of the month. 60. Boom. Done. Now, at this point, I'm just looking for buy side and sell side orders that haven't been broken. So within this quadrant here, where's your highest high? Here. Within this quadrant here, this is the 40-day look back. What's your highest high? Here. So now this is an old high because it's already been broken. So it's just being considered as what? An old high, not an unbroken high. This is an unbroken high here. What's over here in the 60-day? Another unbroken high. So we have buy side. Now we cast forward 20 days because, you know, every 20 days, the market is most likely going to be reaching for some type of new liquidity pool. And it needs to generate, before reaching for the liquidity pool, it needs to generate the liquidity to get there. It can't just run there. It needs to do something in order to get there. That's what you're seeing when price breaks highs and lows. It's doing it on purpose. They can't just get, the commercials just can't just buy. They need to fund the sponsorship. And by funding the sponsorship, what do? They get above the highs. They get below the lows. That's it. 20-day high, 60-day high, 40-day old high. Let's see what happens when we play out the market. What happens here on the next day? Literally the next day, March 2nd, 20-day high is taken. Buy side liquidity is taken. Now, do we know if it's going to keep running higher? We don't know. Let's say we don't know. We're not looking at no macros, we're just looking at price action. Let's say we just know the sound logic of commercials like to sell after breaking highs. That's pretty sound. Everybody should be familiar with that. Selling above a high or selling in a premium is pretty ideal for you as the business, you know, as a businessman or a business lady. You want to sell above a high. You don't want to sell cheap. You want to sell your products expensive. You want to make profit, right? Selling above the high will make you profit instead of selling cheap. You don't want to sell your products cheap. That doesn't make sense. You want to sell in a premium. Price comes up above the opening price in March too. So we have some ideology here. It's in a premium. Price comes above 20-day high. Breaks that. Now we're thinking to ourselves, okay, this could be a sell scenario potentially. Let's say you're not confident to get into this market, right? This feels scary because the logic will tell you, retail will tell you, no, this is bullish. Retail would sit here and tell me that this is still bullish, right? Because it broke the high, breakout, retest. That's not always the case. I'm always putting this first law first. Break a high, potential sell opportunity. Break a low, potential buy opportunity. That's always my sound logic. Break a high, sell opportunity may be unfolding here. Can it reach for the 60-day high? Potentially. But let's say you're not confident to take the sell here instantly after it takes that. What do you have to do in order to figure out if this market is going to go higher or lower? Wait for the next swing point. That's all you have to do. Wait for the next swing point. What is this here? We'll zoom in. That's a swing low. And we'll take off the annotation so you can see it. That's a swing low formation. 1, 2, 3. This is also a swing high formation right here. Even though it's consisted in the same breath here, it's still the same formation. Even though they're sharing the candles for the formation, it's still a swing high, 1, 2, 3, and this is a swing low, 1, 2, 3. Yes, I'm including the other candle from the swing. That is possible because it's still sound logic. There's a swing low, that's a swing high. If a swing high is broken, all right, it's already drawn out. So the 20-day high is essentially the swing high. If a swing high is broken and price action is bullish, what should we expect to happen? A higher swing low, right? Exactly. If a swing high is broken and it is bullish and the momentum is bullish, a higher swing low should form. So it should look like this. Take the magnet off. Price comes up, breaks a swing high. There's going to be probably some retreat. It may swing all the way up here, but we know that a swing low needs to form eventually because they're going to take profit and they're going to reposition themselves. And this is how the retail traders, they see markets blast off and they start to chase price. You know, they're already late to the party. All they have to do is wait for the retracement and wait for the swing low. Then this forms a swing low, a higher swing low. The same thing here. Look how this is a swing low here. 1, 2, 3. If it's bullish, it's going to do that. Doesn't have to do that. If it's not bullish, it's going to make what? It's going to come down and take out the swing low instead. So let's see what happens. Play price forward. We got a swing low. 1, 2, 3. It is higher. Breaks the third candle's high. Magnet on this. Breaks the third candle's high. You have a potential what? High probability scalp on your hand. This high, most likely, odds are, it should be ran. The probability may not be in that favor, or it can be, because setups do fail. Doesn't give you the run on the high. So you have a fail buy setup on the high probability scalp. Runs the low instead. So now we have a swing high after breaking a swing high, and a lower and a higher swing low, and price is coming back around. Now, what am I suspecting here? Is price probably making a turning point? Potentially. But we have to wait. Boom. What is that? Price now takes out a swing low. Takes this swing low out. So is price action probably going back bearish? Potentially. But what do we need to form? We're just following the fundamentals here. What do we need to form now? A lower swing high. What's that? 1, 2, 3. That's a lower swing high. 1, 2, 3. There's a lower high on the left and a lower high on the right. That's a lower swing high. You may now have more conviction and more confidence now to tell yourself, okay, UJ is bearish. The momentum has shifted bearish. And we can see that because there's speed, there's that SIBI or fair value gap. There's a buy side inefficiency. The market is inefficient in selling buy side because it's dropping so fast. It's a sell side imbalance. That's why ICT calls the acronym SIBI. Fair value gap breaks a swing low. There's a shift going on here. Swing high, I would most likely would rather it come into this and then go lower. That's what I normally suspect. May not get that all the time. Or it may do that in a later future time period and come back up here, spike into it, and then run lower. We don't know. But given what we have now, a lower swing high, price action is probably still going to be bearish. And you can see here, look at that large candle down. Momentum is still bearish because we got the confirmation saying, okay, swing low broken. Now we got a lower swing high. That's all I've been doing time and time again, reading this price action. Raw, no indicator. 1, 2, 3. This third candle's low has been broken. This may be the high probability raid on sell stops. That's how you get those large, high probability scalps. If you want to get a nice quick scalp, this is what you wait for. Because you know momentum is most likely going to keep going down. This is the 20-day low. This is the 40-day low. And where's that 60-day? And then we got a 60-day old low. Looks like price could probably come and take these out. Now, earlier, I did take a trade setup off of this bullish order block, right? I was able to grab some profit off of the reaction. This is the bullish order block right here. Price came down to hit it. I was catching buys. Every time I hit it, buy, 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 buy. Eventually, fell through, right? So whatever I made, glad enough I was able to take profit here. But eventually, I took a couple losing trades. Because where did I have my stop loss? I had it at the mean threshold of the order block. Because I really don't want price to get below the midway point of the mean threshold. And people may ask, oh, how do you measure that out? IC says, take the body, take it like that. Not the wick, only the body. And ICT has like a 3-hour-long video on like how to mark out an order block properly. 131, 347. Am I not drawing it out? Oh, yeah. $347 it was. Is it 347? Oh, 131. Oh no, it's 847. I'm saying 347. 8. Sorry. 8. That's the mean threshold. You can see a price coincidentally closed perfectly on it. The candle happened to respect it. But that's where I had my stop loss at because I didn't want to see price dig any more further into the order block. So in the order block theory, watch the video. It's not that I'm changing the words. I don't ever change what ICT is saying. A lot of people like to change exactly what he's saying. I'm going based off of what he's saying in all of his videos. This highlighted area is the order block. Mean threshold all the way up to the high. Yes, there are going to be times where the candle may be small, little body. If it's a large, beefy candle with body like this, you're doing it like that. If it's a candle that's like this, wimpy, small body, you're mainly just going from the open to the wick high. That would be your order block. But if it's a candle like this, large and beefy, there's a large open and closed space in between, you're using the mean threshold to the high. That range here is your order block. You can see how many times buy reaction, buy reaction, and now it's finally probably falling through. Now that doesn't mean to say, okay, it's finally done, because it could ultimately run a little lower and then run higher. But my personal take is I put my stop loss at the mean threshold because anything below the mean threshold is sparse liquidity. It shouldn't really want to get beyond the mean threshold if it is truly bullish. Shouldn't really want to get below here and close below there. But if it gets below here and continues going lower, then odds are the order block is done. It's nixed. I'm out of there. This is not feasible anymore. I'm not hoping for another setup on the order block. It's done. It's done. Take this off, and take that off. If this market is still going to be bearish, sell side liquidity. So even if it's not the IPTA lows, because people say, oh, you're only paying attention to the IPTA lows, Deontay? No, I am not. I'm paying attention to all the swing lows that are not broken. This swing low was broken, as you can see. It's clearly coming down, so taking that sell side. This swing low was broken. This swing low is a potential target. It's close to what? The 20-day low as well. So if its primary objective is the 20-day low, odds are obviously it has to run the low. It's in its way. It's in its path. But what's below the swing low? Sell side liquidity. What's below the 40-day low? Sell side liquidity. And what's here? Just an old low. There could be a reaction off of this low. That's what I like to use the lows that have been broken already. There could be a reaction here, and price can stall. Install, consolidate, reaccumulate, and then it falls through again. You'll see that. And there's examples on TradingView on some of the IPTA months in my previous years. You'll see that price comes to an old low or old high. It stalls around the high, and then it takes off. You'll see that. But it comes with practice, and it comes with actually going back in the marketplace and backtesting it. You can all backtest IPTA. I feel like this is the most feasible model people can backtest without having to struggle because it only takes a couple clicks to do. But that's IPTA for UJ right now. We're going to jump into the weekly now. Let's check to see if there's any chat. Chat. I noticed swing 3 times before reverse. Small candle. Yep. Facts, Aaron. I didn't even mention that. IPTA and oil. You guys want to see that? I'll show it. Since Aaron wants to see it, we're going to show the IPTA and oil. Oil's been in our range for a while. This whole oil ordeal. Oil finally breaking down, man. Falling through that order block. Let's bring it back and just see what we got going on. I know somebody had a question. Let me not neglect that. Somebody said something. I noticed that the swing, something is broken 3 times before it reverses. Notice that the swing is broken 3 times. What swing? If you don't mind me asking, if you could clarify what you notice in the market. This is, I'll move it one day. Oop, okay. 20 bars. 20 bars. Oh, that means it already, oh wow, yeah. I could already see it because I already saw where oil was at. I could already see it took sell side. Wow, man. These levels. It's almost like you got 20/20 vision where the market most likely is going to draw to. And then we got the 20-day cast forward. Now the cast forward can also be 40 and 60. It doesn't stop here. Because in the video, like I said, ICT does a 60 back and a 60 forward. That's the range you're working in. Oil has been moving sideways, choppy. But like as always, standard procedure. You find your highest highs and your lowest low. Highest high. Highest high. Where you at? Here. Oops. Now I'm gonna make you guys red. Good enough. Then we have our lowest lows. Get blue now. All right, tight prices trading sideways, and if you were just to go on the monthly chart, or even actually, yeah, you go on the monthly chart. Prior to this, it was a lot of back and forth, down, up, down, literally indecisive. Candle closes right as it's open. Small, small, and finally a large range cycle for March. But if you go back down to the daily, and as you can see, it showed you exactly where March candle reached for. I don't know why TradingView does that. It should be more. Okay, you're not criticize TradingView. We'll do the opening price. So we'll do a little things a step further, just to add a little sauce on top of it. That's March's opening price. What's the ideology here? Anything above the opening price is premium. Anything below is a discount. Nope. Discount. High probability sell scenarios, high probability buy scenarios. Now, that's not saying, okay, price is under, because when people hear me say that, they're like, oh, every time price is below discount, I'm always going to be buying. That's not going to be the case because we know that there's a power 3 formation for the monthly candle. There's going to be an accumulation, manipulation, distribution phase, always. There's going that distribution is that range expansion. Same way we see on the daily candle. The candle opens, makes a low point, and then all of a sudden it runs all the way up and then makes a high, then it comes off the high and then closes. That space in between the open and close, that's your range expansion. There's a range. It's running away from the opening price and then coming up here, making a high, and then closing off. Same thing happens on the monthly candle as well. The monthly candle, if we take any candle here, doesn't matter which candle we're looking at. Let's just say we're looking at this candle here for 2021, February. The candle opened here, dropped down. Look how it makes a wick below here. So that means there was a low point on the week. For the month, somewhere below the opening price. Then range expansion kicks in. Price runs all the way up, all the way up, all the way up. Makes a high. Then it distributes, takes profits, comes back down, and closes here. So that's range expansion. When I say range expansion, that's what I mean by range expansion. And you can see how they fake traders on the wrong side just to bring it back up to the intended direction. Buying low, selling high. Go back to the daily. We got sell side here, and we got buy side here. The U.S. oil chart, for perspective, the U.S. oil chart is super bullish. I don't totally agree with it because of what's going on right now in the world. But if you guys want to see it, oil. No, it's crude. Super bullish. Looks like the gold. I think the gold chart is super bullish as well, and it might play out this year really well. But you can see it's very bullish. February, it didn't do anything. It was sideways. January was nothing. March, it shows that it goes up and then declines. So there's some type of declining period that it's showing us occurring in March. Play this forward. Wow. Wow. Takes out what? 20-day high. And I haven't been tracking US oil. Shout out to Aaron for mentioning this. But this is just another great example. Should add this to the IPTA library as an example. Another example using IPTA, using the buy stops and sell stops. Price comes up in a premium. Look at how fast they run away from this high. You can tell they stepped into the marketplace. How could you tell? Look how large that candle is. Look how large that is. Look how large that candle is. They stepped into the marketplace. It's not tiny. Yes, each day they are trading, but you can tell when they're fueling the market. Look at how they fueled the market with a large candle. It's physically large. The range expansion between its open and close is large compared to this other candle. The range expansion in between this candle is small compared to this. There's a lot more space in between the open and close. Price takes out the 20-day high, and you can see a dynamic reaction off of it already. Fair value gap. You guys see that there? Look at that. That price comes into it, wicks right into it, takes out the previous daily high. What are they looking to do? It's also still in a premium. Look at when it pulls back up. Pulls back up above the monthly opening price in a premium. Hits what? A premium PD array. A premium PD array. It's above the price action, so it's premium. Hits into it. You get an up close, counter trend candle. So odds are if it's still trending down, counter trend, you sell after this candle. This is a good tip, by the way. If you know you're in the downtrend, just wait for the up candles and sell after it. Doesn't have to be the next day, because sometimes you may get 3 up close candles and then it drops. But you can see up close, dynamic sell off after. And look at where it hits. Sell side liquidity. Sell side liquidity. Aaron, thank you for this one, man. Just to reinforce the idea of what these markets are truly doing. There's no magic behind this, guys. There's none. You could sit here and tell people will sit here and make all these fancy terms and stuff like that when it all boils down to the simple principles: open, high, low, close, liquidity, interest rates. That's it. And speed. That's it. Large and small cycles. Those are the things that I would truly think the markets are comprised of. Of course, you can go deeper and be more complex. Am I there? Am I an interbank trader? No, I am not. I don't know what platform they're using or how they're viewing the marketplace. But I know that there is a strategic way that they're getting into the market and picking their own trades. It's not off of retail indicators. It is not off of retail logic. And it's not smart money. It's all based off of macros and rate of return. What currency is stronger? What market is stronger? Where is my greatest rate of return? Where can I put my money in and get double my money within the next month, within the next year? Can I double my money in the next 3 years trading gold? Yes, so I'm putting my money into gold. Can I double my money in the next 3 years or the next 5 years or the 10 years trading cryptocurrencies? Yes, so I'm putting my money in cryptocurrencies. It's business, guys. It's all business. That's all it is. Same thing with stocks. What companies are going to give me a greater rate of return? You think I'm going to pick freaking some IPO, some new IPO over Apple? No, I'm going to put my money into Apple. That's a tech industry. And Apple has been outperforming a lot of the companies in the market. And it has one of the world's largest market cap. So why would I not want to put my money into Apple? They probably figured something out that the consumer loves. And that's a whole nother spiel. But consumerism. Be an investor, not a consumer. Don't spend your money poorly. Not a financial advisor. Don't spend your money poorly. Save your money and invest it. That's how you become rich. That's how you beat the 9 to 5. That's how you save money for your children and your future generation. Working a corporate job. You can't pass on a job. You can't pass on a job. I want you to know that. But you can pass on assets. Next. Price comes up. Like I said, comes up. Buy side. Takes out the 20-day high. Immediately takes out the 20-day low. And what do you have down here? The 60-day low. And I think it gets down there because price was priced in at 60 and change per barrel. Wow. Night and day. And these are the setup. These are this is my personal bread and butter setups. I love these setups. When it takes out the 20-day high and runs, or the 40-day high or the 60-day high, and then runs to the other side quickly. That's how I was able to show you guys on February, using the IPTA data range, why gold dropped entirely for February, and how I was able to catch that leg down. Because it did exactly what US oil is doing. It took out the 20-day high and then ran all the way down to the sell side liquidity. That's how I'm finding those trades within 20 days. There's no magic behind it. People keep asking, what's the 20-day cast forward for, Deontay? If you watch the video, do your homework, watch the video, do your due diligence on ICT, Inner Circle Trader YouTube channel, you'll see he speaks about what the cast forward is for. It's your range of when you're expecting the trade to unfold. You know within this time period something is going to happen. And you can clearly see something happened in the next 20 days. It's not going to be specifically on the 20th day. Sometimes it is. Sometimes the market stalls, 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 stall. Oh, this damn. Pardon my language. This thing always gets me, this marker thing. Wish there was a quicker way to click off of it. Price will stall sometimes. Stall, 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 stall. And then sometimes you'll see it. It's not all the time. It's a rare occasion. Sometimes specifically on that 20-day cast forward day, it hits the 20-day high or the 40-day high, and then boom, it drops. Sometimes it's like that. Even in the cast forward of the next 20 days. So maybe it might be the 40th day or the 60th day. It does a reaction. There are times in the marketplace it does that. ICT has showed that time and time again. But he didn't want to confuse people saying it's not the specific day that's causing the setup. Sometimes that happens, but it's rare. But it's the fact that in the next 20-day pool, something's happening. But yeah, this was another great example. I'm definitely going to document this for the IPTA data range. Shout out to Aaron. Just check the chat real quick to see if anybody said anything. So, price action in March is the manipulation. Yes, I totally agree, Alex. Yep. I think that normally December, right, the end of the year, December, most likely, maybe even the previous month sometimes. Even like November, it depends. Each year is different. But generally, December and January are the worst months to trade. I know there are some summer months too that some traders will say you should avoid. But normally, December and January, nobody should really be trading because most of the central bank traders are on vacation. You can look it up. They're literally on vacation. Some of them may come back to office earlier than others, but most of them are going to their vacation homes or taking their vacations, and they're off from the market. So there's not a lot of volatility in the marketplace. Yes, the market will still be going up and down. There will be trades being taken, but they're not there trying to make large sums of money. They make their money missed in the bulk of the year. At the end of the trading year, they're trying to celebrate. They're done. Yes, people are greedy, but they're done. They made all the profits all year round. December comes around. If they're in a country or they're in a world where they're in a place where it's cold, they're probably going on vacation to a place where it's warmer to vacate on their yachts or their summer homes or whatever the case may be. Accumulation normally happens here. Manipulation normally happens in January. February, you may see the distribution. You see here, February doesn't happen. It tends to happen here in March. So it's somewhere around those first couple months of the year, in the last month of the previous year, they're building in sentiment. They're building in sentiment for the next yearly candle. Think about that. The yearly candle. You have 12 months to trade. A lot can happen. And each one of those candles are doing almost the same thing. Open, high, low, and close. Power 3, accumulation, manipulation, distribution. Every single time. Doesn't stop. It is infinite. It is fractal on all time frames. Doesn't matter what time frame you're looking at. There's always some type of fractal there. Even from the 1 minute, 3, 15, 4 hour, 8 hour, whatever, 2 hour, whatever you want to look at. Fractal, 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 fractal. It all adds up to the larger candle. That's all it is. All these fractals are just adding up to one daily candle. And all the daily candles are adding up to the weekly. And all the weekly candles are adding up to the monthly. And it's all comprised into one bulk candle, the yearly candle. But this was a great example. So I'm going to jump into the weekly ranges. And then after that, we're going to jump into the interest rate differentials. And then I'll talk about gold. And then I'll take any questions and answer it to the best of my ability. So first things first, we'll jump into the DXY. Hourly chart, my preferred method of looking at the weekly chart. It just looks cleaner on the eye. Time and time again, I will never stop showing this. Any trader out here in the trading community telling you that Sunday's opening price is not influential to the marketplace, please block them, stop listening to them, stop following them. Do not listen to them because they're leading you down the wrong path. Sunday's opening price is very influential to the marketplace. You can see here, this is the weekly opening price. Look at how price is reacting around this opening price. Doesn't take a genius to see this. You can teach this to a child. You can teach this to your future children. You can teach this to your children if you have children now. You can see how simple this logic is. The opening price is fair value, meaning no one's paying a premium and no one's paying a discount. It's fair value. It's almost like if a pair of, and if you are someone that's more familiar with goods and services, most of the younger folks or most of the people that have a younger demographic may understand this. Resale game. People will like to buy high merchandise clothing at retail price. For instance, this is an example. Some people know of the high fashion, quote unquote, I'm putting parentheses around this or quotation marks around this, Supreme or Jordans or some type of high end or Goyard. They'll buy the product at retail price. So they didn't pay a premium as a consumer, at least, right? As the consumer. You didn't pay a premium for the pair of sneakers or the pair of Jordans or the pair of Supreme hoodies or Supreme hats. You didn't pay a premium. You paid retail price. That's what weekly opening is. It's retail price. It's fair value. But theoretically, yes, the consumer does pay premium prices because the company does make these products cheap and then they upsell it to you. But from this standpoint, from a consumer, they're buying the product at retail price. They didn't pay a premium and they didn't pay a discount. But when this person now wants to resell this pair of sneakers or this hoodie or hat or whatever it is, you think they're selling it below retail value? No, especially if it's a hot in stock product, right? If it's something that's real hip and cool for the kids or whatever the case may be, these kids are going to pay a high price for it. They're going to drop dollars for it. They're going to pay at a higher price. So I buy a pair of sneakers, let's just say Jordans, because it's the most classic example that I know most people would understand. Someone buys a pair of Jordans. It drops. They're out there in their local retail store. They're standing out line. These kids stand out there for hours trying to buy these pair of sneakers. They buy the pair of sneakers, and what do? They go on like websites like Etsy or eBay or there's more hip, trendier ones nowadays. I can't name them, but they're going on these websites, right? And then what are they going to do? They're going to up price. They're going to upmark the pair of Jordans. So the Jordans came out for $100, and they're going to do it what? They're going to sell it for $200, maybe $300, $400, which is ludicrous, but kids will pay for it. There's people, grown men too, grown women too, will pay for it. Not just like as kids, but people will repay a higher price for it. That's what's happening here with the opening price. The same thing is happening here. Now, inverse, just an analogy. Let's say there isn't any buyers in the market, right? It's not a hot commodity anymore. You're sitting on this product for too long. Most likely, you're going to want to take profit. You're going to try and break even or just get rid of it. You want to make something off of it, so you sell at a discount, which is kind of a losing position. You still make some money, but you didn't make profit. You might take a loss or you break even. You get your money back worth. You sell it back at retail price. That's what the weekly opening price is. Simple. So that's what they're doing. They're buying it cheap, right? So if the weekly candle, your draw, if you're speculating, now I don't know how you speculate the market, right? From your top-down analysis. But if something is telling you that the weekly candle is supposed to go up and probably most likely close up, it's probably going to buy below discount. Not all the time, but frequently you'll see this. I would say probably 80% of the time. 95% of the time, you'll see that. If the candle is going to close up, it's bringing retail traders on the wrong side, down, and then running up. Buying cheap. Simple logic. Buy cheap. Buy cheap. Buy cheap. Now, on the flip side, if the candle was most likely to close bearish and you were speculating the weekly candle to close down, so from Sunday, or from even from last week or Friday, you were like, okay, next week I think the weekly candle is going to go down. That means you're looking for probably a sell setup either on Monday, Tuesday, or Wednesday, because those are the most primal days to trade. You can see here, Wednesday makes the high of the week, and it comes down and sells off. Now, this week was kind of back and forth because it's not taking a stance. And what I mean by a stance is it's not running away from Sunday's opening price and not returning. So it opens here, drops, then takes a stance and runs higher, and then comes down and closes right there. That's the marketplace running away from the weekly open. You can see here it's not doing that. So there's some indecision in the market because price is threading around the opening price. It's not saying, okay, we're not sure or truly saying, yeah, we're going to break out higher or we're going to break out lower. But from the PD array, like I said, there's that breaker. That's what we traded into. That's Wednesday. We're trading into the retracement. We're retracing into that breaker and again coming lower. That's what's happening here. Retracement into it. Now we're trying to leave that. But you can see how they bring it into a premium for the sell opportunity. They bring it in a premium. Let's move on to GU. Same idea. That's Sunday's opening price. People ask me, how do you find the Sunday's opening price? Go to your weekly chart, put your cruiser on the opening price. You literally come here, take this off, go to the weekly chart. If you're using TradingView, or even if you're using a broker's platform, just go to your weekly chart, hover your cruiser here, and look for the O. Just look for the O. That's the opening price. Right there, draw that out. You got your opening price. Done deal. Hopefully that answers that question for some people, because some people struggle to find the weekly opening price. And hypothetically, let's say, I don't know if it would be possible nowadays, let's say your broker doesn't have a Sunday candle, right? Even though everybody uses TradingView. I don't see why you would not use TradingView. But let's say you can't find Sunday's opening price, use Monday's opening price. It's going to give you almost the same reading. Use Monday's opening price and draw it all the way out to Friday. Same idea. You're using it as your weekly open, quote unquote, Monday's opening price. But if you have the opportunity to use Sunday's opening price, please use Sunday's opening price. Premium, discount. High probability sell scenarios, high probability buy scenarios. Just looking at this chart, before we get into all the days and break of highs and break of lows and what's going on, you can see where sponsorship is clearly occurring. Night and day. Look at how price comes right below Sunday's opening price, and then boom, we get that buying opportunity. Yes, we know on GU, it's trading into that breaker there. That's why we're getting that reaction there. So from a price action perspective and a PD array perspective, we're trading off of that breaker. Discount, high probability buy scenario, right there. Price runs back up. Monday is taken out by Tuesday's high. You see that there? And a premium. And like I said, the commercials like to sell after breaking highs. Mondays, I personally don't like to trade. Sometimes you'll have big dynamic Mondays. Hey, if you want to trade Mondays, that's your trading plan. Deontay's personal trading plan. Normally sit on the sidelines for Sunday and Monday, unless I get a Sunday gap. Those are setups I like to trade. The Sunday gap. If there's a Sunday gap, I like to trade it. Gap open, price comes into the gap, then I try to buy it back or sell it back, whichever way it gaps, because I know retail chases after gaps. Sunday, let's say I don't trade. I totally don't look at. So I'm taking Monday's high and low, and even Sunday's high and Sunday's low, and I'm looking at that, and I'm seeing if Tuesday is going to break a higher low, and where are we in price action when it happens? It breaks a high and a premium. You literally have the best opportunity to find a short position here. And not saying, oh, it's a cheat code. Well, it kind of is. You have 20/20 vision of almost where the commercials are most likely going to give a sell position. A, above a premium. B, above a high. C, probably during a session. Whether that is London session or New York session, and even sometimes London close. I would prefer it to be London or New York. Sometimes it happens in Asian. But I would prefer it to happen in London or New York. And it happens here in New York. It takes out the New York high. New York comes up and takes out the previous daily high. London literally consolidates. You can see consolidates all the way through. We'll put on the sessions for you guys. London consolidates. runs up, comes down. What happens after we take this high out? You can see quick repricing. Large candle up, another large candle right back down, almost the same size as the candle going up. It wasn't small. It wasn't like a tiny little weak candle. This hourly candle was large. It said, yo, get me out of here. It's telling you. The indicator doesn't need to tell you this. You can see the price action. It's almost if you're reading body language or you're reading, human personality or human, characteristics, You can read somebody. Read the price action. It's telling you. It's telling you. This is not shy price action. This is not timid price action. This is get up, get out. Get up, get out. Price comes up, comes down with almost the same size, so it rebalances. There's no gap. There's no busy. There's no buy side imbalance, sell side inefficiency. Comes up, next candle opens, and it immediately comes back down and fills the sell side. So there's no sell side inefficiency. Comes down, no fair value gap. So it tells you, okay, odds are it's probably going to keep going lower. And what happens? Normally what I like to do, I wait for the fair value gap. And you'll see in the Telegram channel, if you check, I had this fair value gap marked out right. Apologize, there's a helicopter passing by. It's the feds. Here we go. Fair value gap. Fair value gap, price trades up. Yes, it trades through it. Happens. Not always going to be perfect. Trades right through it. But when does it trade into it? During a session. During a session. That's where you're most likely primarily trading. I tell traders all the time, if you're trading outside of any of the highlighted areas that you see on my chart, if it's not highlighted by the indicator session here, you're chasing price. Or you're going to be chasing price and stuck in a consolidation. And I mean, there is another session here. There is the London close session. I don't have it here because I want the chart to be clean. But the London close will have reversals. And you'll see here, the London close gave a reversal opportunity here. Back down where? In a discount. And the London close, natural characteristics. What is going on with this helicopter, man? Okay, apologize. Glad they're not after me. So, fair value gap here. And like I said, the sessions are not what I'm trying to trade in. But I was saying the London close, its natural characteristic is normally a reversal to the daily trend or potential continuation or consolidation. All of these sessions have their own characteristics. We know that the Asian session, especially for the dollar cross pairs or the base or the currency pairs that are based in dollar, during the Asian session primarily, you're going to be faced with consolidation or accumulation, sentiment buildup. They're building up buy side and sell side for the next if the true day range. That's what's going on in the Asian session. And sometimes, yes, it happens in the yen cross pairs because the Asian session in itself is small in nature. The Asian session doesn't have what? What largest central bank isn't trading during the Asian session? The Federal Reserve. That's it. But besides that, London session normally is going to be the manipulation phase. You're going to see price come up or come down. If it's bullish, odds are London makes the low. Not saying every single day, but you have an idea that it's going to make the low. Vice versa when it's bearish. We know London when it's bearish, if you study ICT long enough, and you're versed in that world, we know if it's bearish, London session is most likely going to make the high of the day. Not all the time, but you have a greater understanding of where it might form. You can see here, instead, New York made the high of the day. That happens too. That happens. And you're not always going to get that right. New York makes the high of the day. Price comes down. We got a fair value gap that forms during what? Some people know this as, the central bank dealers range. I don't use the central bank dealers range. I don't use the Asian session deviations because I just know price is chasing highs and lows. That's it. If I was going to take a sell opportunity here, where would I most likely try and draw it to? This low here. That's the most logical sense. Yes, it's going to run this low here. But if it's going to be worth my time getting into the sell opportunity, I want to run for this low. And I know if I do the standard deviation, it's going to show me probably it lines up with this low. But it's pretty obvious that price action chases highs and lows. That's why I don't really use the standard deviations. I just don't think it's feasible. And I don't think I'm well versed on it. That's another thing. If I'm not well versed on anything, I'm not going to speak on it. I'm not going to sit here and lie. Because I know there's traders out here that will try and talk and convince you that they know a concept. If I don't know the concept, guarantee you're not going to see it on my YouTube channel. You're not going to see me post about it on TradingView. Yes, I've posted about central bank dealers range and Asian standard deviations back in the day when I first introduced to it, when I was back testing it and trying to understand it as my trading journal. You don't see me post anything about that anymore because I don't use it. Simple. Price comes back down, trading into the fair value gap. When does it trade into this fair value gap? During the London session. Price comes up, boom, hits it, and then runs away immediately. Quick repricing. Immediate repricing. New York comes in, probably some type of optimal trade entry or trading back into inefficiency. See how price spikes back up? Trades to fill in some of that buy side that hasn't been filled on the upside because this is a fair value gap, so it's a SIBI. Yes, there's one up here as well. Doesn't get back up there. Unfortunately, it only gets back down to this one. Then price comes back down, takes up the sell side liquidity after taking out, excuse me, after taking out the sell side here, what is most likely going to happen? Commercials most likely buy after taking out lows. And where does it break the low? Below the weekly opening price. Now you're telling me that there's traders telling other traders in the trading community that Sunday's opening price is not influential. I challenge that. I challenge that. Buy down here, right? Price takes out the low and runs higher. Look what happens after this low. It's not that I'm like trying to cherry pick things, but look what happens. Look at this fair value gap. It's tiny. It is tiny. Don't get me wrong. It is tiny. But look at the fair value gap after taking out that low. Random, right? It's gotta be some type of selling pressure and buying pressure. No. It's the algorithm reaching down and correcting itself. Doesn't like inefficiencies. Doesn't like gaps in the price. It wants to fill that order with some type of sell side. Price comes down, hits it multiple times during what session? New York session. It's not hitting it during an unhighlighted area. And if it was hitting it during an unhighlighted area, do not take the trade setup. It's probably less likely to fail through. So let's say, and what do I mean by that? Let's say price is here. We're not in the Asian session, right? And price came up here and came back down into it. That doesn't necessarily mean that that trade is high probability. Because price could come back down below it, and then back above it, and then back down below it, until it gets into a session and it said, okay, we got the volume, and we got the institutional backing behind us, because it's currently the session that's open and it's trading. And that's what happened. New York session has the institutional funding behind it, comes down into it, and trades away from it. And ever since that, it goes all the way back up. And where does it reach again? Look at how it comes back down below Sunday's opening price. One more time. And a discount. This is not magic. This is not something that you can't find by yourself. This is not something that you can't do every single week. High probability sells above, high probability buys below. However, it is the experience that you need to understand what's going on in the marketplace. Just because you know high probability sell, high probability buy, doesn't mean you're just getting in here selling anywhere. Because then you run yourself dry. Because let's say you sell right down here. That's a lot of drawdown. You may not be able to handle that depending on your equity. The commercials can because they have an infinite amount of funds. They can hold that trade all day. They hold positions and transactions all day, way longer than us. They can hold drawdown way longer. But for us, there's psychological pressures. There's actual legitimate pressures because either you're gonna blow your live account or either you're gonna lose your gains, and you don't want negative gains. We all want positive gains. We want a higher rate of return, day after day, week after week, month after month. We want to compound higher and higher. We don't want to lose rate of return. You're in this market to make money, not lose money. It's not a game. You're not putting live funds, working your 9 to 5 job, coming here, funding your live broker, and then blowing the account. That's ludicrous. Do not fall into that cycle of being addicted and not truly learning the market. Take time to learn this market. Demo trade for 6 months. Demo trade for a year. What I'm telling you is not bad advice. This is sound advice. I think anybody reasonably in the trading community would tell you the same thing. Don't trade with live funds. The only people that are probably trading with live funds are A, greedy, 2, desperate for money. Take your time. Don't be desperate. It's going to come. Don't be greedy. It's going to come. Sometimes the trade setup does not happen for days for me. Sometimes I'm waiting for a specific trade setup, and it doesn't happen until 2 weeks later. And then I'm like, yes, boom. And it's well worth my time waiting because it's greater for me to find that greater, easy setup that follows all my filters and checks all the boxes, and I'm more comfortable taking the trade. If it only checks 2 out of the 3 boxes, then I'm like, I'm a little iffy on it, you know? Then I'm like, maybe this trade might fall through. And then the other side of me is trying to convince myself, this trade is going to work. This trade is going to work. And then I take it. Hey, it's a flip of a coin. There's probably a 57% chance, 58% chance that the trade wins. It's not, and a lot of people keep saying trading is 50-50. It's not 50-50. I'll tell you that. It's not a 50-50 coin cost that you're going to win or buy or sell. Odds are it's probably a little higher than that, or it's a little lower than 50%. But find your filter and take your time. Is it worth chasing peanuts all week? Or is it worth waiting for a nice weekly setup that's going to make you 300 pips, 400 pips? Is it worth that? Depends on the style trader you are. I personally like to swing trade. That's why I'm always on the daily time frame. I'm looking for those higher time frame PD rays, higher time frame bullish order block that you guys saw me trade on UJ and gold when I took that sell on gold. And I took that buy on UJ. Eventually, they fell through. You guys can see on the chart it fell through. But was I able to make a lot of profit off of that reaction, off of that higher time frame PD array? Yes, I was. I was very profitable there. Does it happen all the time? No. But that's my style of trading. Higher time frame only. Daily, weekly, monthly. Love to play in those playing fields because the higher the time frame, the closer I am to the overall trend. The lower the time frame, the more confusion, and I'm gonna say this in quotation marks around it, the more noise. It's not noise, it's just cycles. There's phases going on. Because you're on a 15-minute time frame, there's a lot more things that need to occur in order for you to see the daily candle expand up. There's a lot more things for you to see occur for the weekly candle expand up. It takes time. But when you're trading on the 1 minute, you're going to be stuck in probably a phase of manipulation, time distortion. Price is just sitting there stalling, just going back and forth. You're like, what the heck is going on? Why is price just going back and forth for 4, 5, 10, 15, 20 minutes? Probably waiting for the news event. Yep, manipulated at its finest. Probably waiting for the news event, the most anticipated news event. Everybody's waiting for NFP, right? Normally, traditionally, it's the first Friday every month. Waiting for that first Friday every month, right? That week tends to be really small, seek and destroy. And as soon as Friday comes around, Asian session is tiny. London session is tiny. And then New York session is tiny at first. And then all of a sudden, we're getting around like 8:15, maybe even 8:10, 8:30. Boom, the news drops. Fume, the thing flies. And then everybody's in the market chasing. What are you chasing price for? You know that the market was going to stall, but instead, everyone is going to chase price prior to the news event. They're going to watch NFP. They're going to try and trade the London session, the Asian session, and they're going to trade right before NFP, you're gonna sit in time distortion. I just want you guys to know that most highly anticipated news events are gonna be met with a phase of manipulation, and they're gonna hold the price action there. And you're gonna be like, did the markets freeze? Is my charts looking like this, or is it just TradingView, or is it just my broker? No, it's everybody. Everybody's witnessing the same thing that you're seeing. And then the news kicks in, and then boom, it's like a bullet coming out of a barrel. It just flies. It takes off. Gotta be patient. Gotta be patient. And sometimes it's best to leave the news events alone, especially the high anticipated ones. I don't trade news events as much as people think. I don't. Medium to small impact, yeah, I'll trade. But the very high anticipated ones, like interest rate decisions, FOMC, NFP, non-farm payroll, oh, I'm leaving those alone. I'm just putting my feet back because I know that markets can get really riled up and people are going to either get pulled on the wrong side, and the news is just an excuse for them to move the price action. It's not the news release. It's not the data. CPI numbers come out negative and the market still goes up. The CPI numbers come out positive and the markets go down. Doesn't make sense, right? Doesn't make sense. Yes, there are going to be times where the data comes out and it's positive and then it looks like it's reflected in the price action because the market is going up. No, it's not because of that. It's because of the liquidity. It's because of where they want the markets to go. The CPI numbers can come out and it's negative and then the markets shoot up for some reason. Everybody's like, what? That doesn't make sense. Yes, it doesn't make sense. None of it makes sense because it's manipulated. You're trading in a asset class. All the asset class, stocks, commodity, bonds, futures, cryptocurrencies, they're all manipulated. And the faster you understand that, the quicker you understand, okay, the markets are already against you. You already got the odds against you. So you need to be informed about what's going on. And it's a lot of layers to it. It's a lot of layers to it. We'll jump on to UJ. Sorry for the rant, but it's important. It's important, man. Those little things are important. It's not just, get in, trade every day, trade every day, trade every day. Those traders that are trading every day are not profitable. Weekly open. Once again, premium, discount. Here's a little different. Like I said, look at how price comes to that Sunday's opening price and gives a reaction. Doesn't have to go into the premium, but it returns back to almost fair value and then gives a reaction lower. This whole time they kept price action below the weekly open. That tells me that this market is under heavy distribution. This market wants to go lower. They don't want UJ going any higher because they've never brought UJ into a premium range. This magnet. They never brought UJ into a premium range. That tells me that they want this market to not accumulate and go higher. They want this thing to continue dropping. These are the signs I look for. This weekly candle and this weekly range, when you look at it this way, it tells you a lot more information. It tells me that they don't want price up here. They don't want it up here. The whole week. They could have, if they wanted it to, because they could have. Like I told you, if they want price to go in the premium, they will allow price to go in a premium. But they do not. Opens, comes down, comes up, consolidates, comes back up again, finally drops back down, takes out the previous low. Previous lows, 1, 2, comes back up, consolidates. A lot of consolidation. Reaccumulation, boom, comes up. Look at that. Unless you knew ahead of time that this weekly candle was going to continue to drop, you would have been profitable. This might not be a great trading environment this week for UJ. GU was great because you can see it's given that sponsorship. It's coming into that premium range. Oops. It's moving. It's moving. It's moving. I don't like when the markets move sideways. That's not good. Because GU could have sat like this the whole time. like that, the whole time, right? And didn't allow anybody to catch this discount buy. They just allowed you to. It was permitted twice. One time, I mean, this is London close. So, like I said, reversal on a Wednesday makes the low of the week too. So many confluences here. London close reversal, 10 a.m. to 12. Price reverses. Then what happens? Thursday comes back again, gives you another opportunity to go long and a discount to go cheap, buy cheap. UJ, however, did not allow anybody to get that premium sell off. So they're most likely putting this market under heavy distribution, hedging this market really seriously. EU, great example again. It's correlated, directly correlated like GU, and inversely correlated to the dollar based currencies like UCAD, UJ, USWISSY. You can see here Tuesday makes the high of the week here during Asian. Theoretically, because when you guys look at this, you guys are thinking that this whole daily range is together. The new daily candle starts right here. This is what confuses a lot of people. 5 p.m. Now, I had someone in the channel ask me, is 5 p.m. significant? It has to be. No, it is not. The market is taking a break. It's not. Bankers are going on break, or they're getting off of work. They're done for the trading day. They've made their capital. They're going home. Then Asian session starts. That's when it's significant again. The new daily candle starts here at 5 p.m. New York Eastern Standard Time. So even though you're seeing it displayed like this on the hourly chart, what time is it? Said I was going to do this for an hour. Just love this. Monday, Tuesday, Wednesday, Thursday, Friday. Even though you're seeing it displayed like this, and it looks like, okay, new days, new days. No, each one of these days is IPTA's true day range. When the algorithm is now permitted once again to start seeking buy side and sell side above previous daily highs and previous daily lows. That's when it's permitted to start moving. 5 p.m. is the new daily candle. So technically, Tuesday's high formed right here at 4 p.m. You can see right, or even at, I don't know which one's high. Let me check. 17. Yeah, 4 p.m. Technically, Tuesday's high was here. But I like to show it as, okay, on the hourly chart, just to keep it simple so people are not too confused. Monday, take out this high right there. Technically, like I said, the high is here. Tuesday's high is here. And Wednesday, this is Wednesday's candle. The Asian session is already priced into Wednesday's daily candle. Wednesday comes up, takes out the high. But I don't want to confuse anybody too much. But if you do your own due diligence, you'll know that the new daily candle starts at 5 p.m. Even though the new daily candle forms and it's a new Wednesday candle, it's still Tuesday's day. Don't get confused about that. But it's a dead zone. Just to answer that question, somebody asked that, what about 5 p.m.? If it starts a new day, if technically the new daily candle starts at 5 p.m., isn't that significant? No, it's not significant. Use the midnight opening price. Don't use the 5 p.m. opening price. Use midnight. It is more influential in the marketplace. 12 a.m. is the algorithm's new opportunity for premium and discount. As soon as 12 p.m. starts, it's the same concept here. It's already pricing in what overbought and oversold is. As soon as it hits 12 p.m. and the opening price starts, it knows it's overbought and oversold conditions. And then it's ready to rock. You can see here, Tuesday takes out what? Monday's high. So Wednesday sells lower. There was no opportunity to probably catch another to go short here. The price just takes off. London, choppy. It's just sideways price action. It's tiny, 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 tiny. But you can see here, even on the lower time frames, the same thing is occurring here. Remember when I tell traders that Larry Williams said in his book, Long-Term Secrets of Short-Term Trading, large range, small range. I saw Aaron pointed out in the chat. It's happening on all time frames. Like I said, fractals. Look at these small candles. What happens after small range candles? Large range candles. They're jumping in from a small range, then a large range. Most of the times when traders are trading and they see no profit, right, immediately, it's because you're trading in a small range cycle. Yep, that's it. When you don't see immediate response from your trades, when you click buy, you click sell, and you're not like getting dynamic 10 pips, 15, 20, 30 pips, and you're just seeing Price go into profit, drawdown, profit, drawdown, back and forth, back and forth, back and forth, back and forth. You're in a small range cycle. Yep. And then when you're not in a small range cycle because when you click buy and you click sell, the market is just in profit or it's just in deep drawdown. It's not just stalling and price action. Your profit isn't going anywhere. Your drawdown's not going anywhere. That's a large range cycle. What happens after large range cycles? Look at this large range. What happens after large range cycles? Small range. Look at how tiny these candles are compared to its previous candles. All these candles are large. Large, 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 large. None of these candles are as large as these candles here. And you can even see for the rest of the week, none of the candles after this large leg down, none of the candles are as large as these candles here. It's done on purpose. It's done on purpose. They're building in more sentiment. Small candles get the traders uninterested in the marketplace so that the commercials can take advantage once again. Because when traders see this small range London session, what are they thinking to themselves most likely? Nah. I'm going to go look at another pair. I swear to you, this is what they're thinking. I know it. I know this is what's happening. They're looking at, EU's boring. Okay, next pair. Gold's boring. Next pair. US oil's boring. Next pair. Crypto's boring. Next pair. And they're never sitting there long enough to catch this. They're never, because they're not patient. It's the same thing with the daily candle. You get one small daily range. And then everybody's like, man, this market sucks. I'm about to go back to S&Ps. I'm about to go back to stocks. I'm about to go back to indices. I'm about to go back to something else. And by the time they jump out of it and they come back, they're like, holy smokes. Where did this large candle come from? Because you weren't patient. And what happens when they get the large candle? They go chasing the bone like a dog. Every time. And I tell people all the time, I'm not a dog. I'm a wolf. I am the market maker. I'm not chasing price. I want you to chase so that you can fund my sponsorship. You're the trade-off. Retail is my sponsorship. That's why I think about the market. I don't think small. I think large. I'm not a retail trader. Even though, yes, I am a retail trader. Thank you guys for letting me know that. I want to be with the big dogs. I want to be in the commercial speculators playing field. I have their glasses on. I don't have the retail lens on. That's too small. I'm not a kitten. I'm a lion. I'm not tiny. Not a sheep. I am a wolf. This is people chasing price when they see that. Some people are able to catch that because they were patient to catch it. But when people see this, they're like, dang, I got to chase it. And what happens when they chase price? Everybody starts going short. I'm going to go short. And what happens? Most likely they short at the low of the day. They start shorting at the low of the day. They already missed the boat. They missed the boat. The party's already happened, my friend. It all happens in these highlighted areas. That's where the party is happening, most likely. Yes, you can see here, it happened during the London lunch session. Happens. That happens. You get those times. But most of the times, the most dynamic trades are coming inside of the sessions. And people are trading outside of the sessions, or they're coming back to their chart because they're shuffling through 8 pairs. They're never consistent. Focus on 1 or 2 pairs. People got 8 pairs. Why are you watching 8 pairs? I never understand that. Why are you watching 8 pairs? And I had a trader back in the day tell me, "Oh nah, I get into like 8 currencies because that's how I make more money." That's how you lose money. Focus up. It's not like stocks when you're trying to diversify your portfolio, It's not like that. You already have a diversity of picking 3 to 4 currencies. Pick the majors. Pick EU, pick AU, pick GU. Done. You're done. And then look at some inversely correlated pairs. But no, everybody's looking at every single EJ, EG, NJ, UCAD. They're looking at all 20, 50 baskets of currencies. I'm like, you're never going to find a perfect trade setup, or you're never going to find a model that works for you because you haven't sat down and back tested one currency pair for the next 6 months. You never do it. You keep avoiding that because you think you don't have enough time. You have time, my friend. You have time. You're not going to die tomorrow. You weren't born yesterday. You're not a baby. You have time. You can dedicate 6 months of your life to demo trade. Do it. It will pay you off. It will pay you forward. I'm telling you, take this advice. No one's going to take the advice, though. They're going to trade. They're going to get the live funds, get their 9-to-5 job, and waste their time. Older traders have already told us time and time again, stop wasting time and actually do things that will help you and benefit you. You're falling back into old habits again. Your old habit is overtrading, not back testing enough, not getting enough sleep, not trading during trading currencies. You're not doing things that are going to set you up for success. Successful people have routine. People chase price here, and they go short here. And they're foolish because what's happening? They're going short at a discount. Foolish. Why are you selling cheap? I thought the commercials buy cheap. So why are you selling cheap? No, because I saw price action drop in Deontay really fast, so I thought I had to get in. Like I said, that's not always the case. That's not always the case. You can see here, retail probably buys, chasing after these large candles. The commercials throw them a bone. And they start chasing. Yes, finally, EU is going to drop. It's going to drop. It's going to drop, Deontay, I got it. And then what happens? Boom. We pull it back on their stop losses. We pull them back into drawdown. It's crazy when you see this market, man. They really coded this market really unique. But only the real people in the trading community are going to tell you these things. Telling you, people are not telling you this stuff, bro. I'll sit here and watch these people's live sessions, and they'll talk about, yeah, I just get into the trade market. I just open my chart and just start trading. What? What? They're gonna bust out the RSI and the Ikomoku cloud and the the moving averages. I'm like, bro, you don't need that. Yes, it may aid with a little bit of confluence. I'm not sitting here saying altogether, okay, you can't use one indicator, you can't use two. But first, learn price action. That's why my motto is indicators are detrimental to a trader's development because everybody's using it as some type of cheat code. It's not a cheat code. It's a lagging indicator. It's just to help with further analysis. But people are using it full-heartedly. Yes, the RSI crossed over. Buy. The RSI crossed over. Sell. No. You got it backwards, my friend. AU, like I said, look at UJ, is doing exactly the opposite. You can tell that the commercials did not want anybody this week to get a discount buy. They didn't want anybody to get this discount buy because not one time did they lower price below the weekly opening price. Not one time. Price comes down, gets close to it, close to fair value. Now you hear ICT say this all the time. If you're going to go short or you're going to go long, you can either buy below midnight opening price or at midnight opening price or around midnight opening price because it's still an ideal buy spot. Same thing vice versa. He would tell you if you're going to sell the marketplace, you're going to sell above midnight opening price or around midnight opening price because it's still an ideal sell scenario. That's it. Buying close to the weekly open was probably ideal. But you may have not seen that. I personally would not have seen that. From my experience trading the market, I would have never seen that. AU would have been not feasible for me, right? I would have looked at this as probably a selling opportunity. Somewhere here was a selling opportunity. Because of what? I'm not opening this up. There we go. Tuesday comes above what? Tuesday. Keep saying Tuesday. Wednesday. Because like I said, 5 p.m. Technically, 5 p.m. starts a new daily candle. Comes up and takes out Tuesday's high. And then runs lower. Asian session comes up. Runs lower. Is there any fair value gap here after taking out that high? Yes. There's one here. When does it hit this fair value gap? During the New York session. Do you guys see that? The sessions are high probability where your trade setups are going to form. That's it. Don't rush the trade. Yes, you see the fair value gap. You see it. Yes, you see it. But are you inside a trading session? No? So wait, have some patience. Are you inside a trading session? Yes. Now wait for price to get in there and execute. Hit your mark. Pull the trigger. Don't get nervous. Get into that market and execute. And you can see, like I said, the whole week, they just kept pushing price higher. They didn't allow anybody to get into this market. And even though it isn't a premium, what happens here as well? It takes out the previous daily low right here. Takes out the previous daily low here, and then it starts running back higher. So yes, the commercials here are hedging. They're buying in a premium. Unfortunately, they're forcing everybody to buy in a premium. That happens. They're going to force all the retail traders, all the large speculators to buy in a premium. We may not be able to afford that because it's too expensive, but they can do that. You see how it's rigged? That's how it is. That's just how this market is. Because for you, ideally, you want to be buying down here. It's safer to do that for yourself. It's less risk to your asset, it's less risk to your equity to buy cheap. It's always better that way. Imagine trying to buy a new home right now with inflation and the rising houses in real estate right now. You're buying in overbought conditions, premium. All these houses are overvalued. You think anybody's buying? I mean, there are some people foolishly. I mean, not to say they're foolish, but like, it would suck, but they're kind of forced. If they're looking for a new home, they're trying to move out from their parents' house, or if they don't have the patience to wait for the housing market to come down for cheaper prices, they're going to buy in a premium. And right now, everybody is forced to buy houses in a premium. That's it. You see how that analogy still goes with this market? It's the same thing. It's all transactional. It's business, 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 business. Look at this as business. They're just making transactions. The zillion dollar, I don't trade New Zealand, honestly. Last currency I really look at. So we're not even gonna look at that. But now we're gonna jump into the interest rate differential briefly. I'm gonna take a couple minutes of your time. Thank you for those that are still here listening. If not, you're gonna be listening to this recording on YouTube. Appreciate you guys. Just check the chat. See if we got any. We got a few. What? ICT says. Yes, absolutely. You're either gonna sell at or above the opening price, right? If you finally come down to your analysis, you break down everything, you finally come to the conclusion as a trader, tomorrow gold is supposed to go down. Okay, that means sell above midnight opening price or sell close to midnight opening price. Because if it's trading down, it's trying to get away from fair value. Think about that. It's trying to get its range expansion away from the opening price or midnight opening price. Same thing vice versa when you're buying. What is your take on trading next week? Shout out Andrew, what's up? Since it's FOMC week, will you advise an active trading within this week? I would trade. I just wouldn't trade the actual event. That's what I would look. I would look for smaller setups. High anticipated news events like that, got to be careful. Interest rate decision, Fed's coming out talking about rates either going up or they're lowering it. You want to stay clear of those days. Any other day you could trade. The weeks I don't like to trade personally is NFP weeks because they tend to be seek and destroy weeks. Tend to take the high, then come back down, take the low, and then consolidate. Then do the same thing, run up, take the high, run the low, and it's just a choppy week back and forth. So NFP weeks I would avoid altogether. If you have experience trading the market, do as you please. But me personally, NFP weeks, stay clear of the market. That week is going to be just chop. It's going to be carnage. Interest rate differential. So the two primary drivers of this market is liquidity and interest rates. That's it. That is it. Interest rates are a direct correlation to the currencies. So the higher the rate, odds are the higher the yield. And the higher the yield, the more investors are going into that currency. That's it. Does that mean it's going to be soundproof for every single currency that exists in the world? No, because there's some currency in the world that just have no value. Nobody wants the yuan, Singapore dollar, yen dollar, I mean, yeah, yen is probably one of the as well as one of the higher ranked currencies in the world. Even though it has a negative rate, it is still seen as a safe haven, which doesn't make sense to me. But an interest rate differential is essentially when you take a country or a central bank's rate, interest rate, and you find the difference in between. So if we look at this basket of central banks, and we're only going to look at the major currencies or the major banks in the world. We're not really looking at the Mexican bank, the Israel bank, Indonesia, India. We're not Danish. We're not Chinese. No, we're not looking at those. Brazilian. We're not looking at those economies. Tend to be unfortunately. Not to say that these countries are not lovely living places. The economies tend not to be booming in those places. That's just how it is. Hey, look at the data. The data tells you. I'm not trying to pick on these countries. But we look at the countries like Aussie, Australian, America, China, Europe, Japan, New Zealand, New Zealand, New Zealand. I'll let it slide. New Zealand, Switzerland. Yes, those countries tend to have better GDPs, tend to have better growth year after year, right? If you find a currency, or I mean, if you find a country and you pair it with another country and you look at the rate, odds are you're gonna find a currency as well, and it's gonna be reflecting that same thing. So, for example, the biggest example here, the most obvious one, United States Fed. Is this clicked? It is clicked. United States, right? Even the prior rate was 4.5, but let's just go with the current rate. It was 4.7. All throughout the pandemic, they've been, hiking rates, quantitative easing, printing money. Yes, yes, yes. We all know. Everybody's been seeing all the central banks print money. But then if we come down to Japan, yen, BOJ, the Bank of Japan, we see they had negative rates for a very long time. A lot of the countries had negative rates for a very long time. The global economy has not been used to higher rates in almost a decade. This is almost a decade now where the economy is now getting stimulus. Like, oh gosh, the central banks are printing money. Oh gosh, the central banks are increasing interest rates. So things are starting to move. The gears are turning. You can see Japan, however, still in the last decade, has yet to touch their rates. It is negative. So we're taking a positive rate and taking a negative rate. We can see the difference here. There's clearly a huge difference in between 4.75 and a negative zero point 0.1. We can clearly see a difference. Negative rates and a positive rate. There's a clear difference when you take those numbers and subtract the percentages. So when we come to the price action, and I'll just use this template as an example and take this off. USD JPY. So we know the Feds have the higher rate. Go to the monthly chart. I'm going to go back to 2016 because that is still the last time they've changed their rate, and they changed it to negative foolishly. Unfortunately, whoever's running that country and their monetary policy needs to probably rethink things. Inflation is hurting them. I know it is. 2016 here. Yeah, beginning of the year. It's 2016. That's when BOJ, Bank of Japan, went negative. They went negative on rates. We can see here, for the first couple years, you can see here, for the year at least, 2016, the entire year for 2016, dollar took a hit. Okay, cool, fair enough. But long term, what happens overall? Dollar is going to outpace the yen because in more recent time, it's been hiking its interest rates. And overall, it had a positive rate at the time. I would Google to see what the rate was of 2016. But do your due diligence. I can only assume 2016, the Feds probably had I can only assume a zero flat rate or a positive rate. I know the Feds never had a negative rate. Yen has a negative rate. So people are most likely saying, what? Why should I put my money in yen? Let me take my money out of yen and let me go get some dollars because there's clearly going to be yields on that, and I'm going to get a rate of return on my dollars. It's going to move up in currency value. Year after year, the dollar has outperformed almost all the currency markets. Why is that? Because it's the national and the global reserve currency. It's been rigged to be that way. It's not, hey, don't point fingers at me. I didn't make the system. Dollars happen to be the world reserve currency. America happens to have their hand on the power right now. That's just how it is. The US dollar has the power. And everybody goes back to the dollar when things start to hit the fan. You can see this. Negative rates. What happens after 2016 finishes? Look at after 2016 finishes. We got 2017. Go to 2017. 2017, we can see they start accumulating dollars. It's moving sideways. Yeah, it is. It is. But look at the fair value gap. This is the monthly chart. I want you to understand, this is the monthly chart. That is speed up. They told you that they're most likely going to get into this market. They start buying dollars heavy, quick. This is a very large monthly candle. It is one of the most largest monthly candles in the year of 2016 itself. And prior years as well. You could look at the chart, you could just tell it's the largest candle it's been in years. And not talking about the wicks either, talking about the body. That candle is very large. They're buying dollars and they're selling yen. What happens after this? Many years, they get everybody probably dumping back into dollars. And what are they doing? They're probably taking profit because they're taking advantage. The central bank traders, the interbank traders are taking advantage of that negative rate and the positive rate for dollars. So they're getting a great rate return for buying more dollars. It's increasing in value. My purchasing power increases when I have dollars, not yen. It goes up. They probably take profit here, coming back into probably some inefficiency. You can see here, right? Or some bearish order block. Not going to get too nifty with it. But you can see they come up here. They probably take profit. They take profit. Price then starts to accumulate. And it's slowly trending down, but it is accumulating. This is a range. Range. Monthly chart. Range bound. It's moving back and forth. It's not making significant highs or significant lows. Where is the range? There's the low that it came from. And that's the high that it came from. It's in this range for many years. Many years. But I'm telling you, they slowly take advantage of this. It doesn't happen overnight. It takes a couple years. See, slowly, they accumulate the orders, and then finally takes off. It's reflected in the price action. The Fed start increasing their rates. Dollar starts becoming even more valuable because the rates and yields start going up. What happens? We get a super bull cycle in UJ. Price takes off instantly. Now, obviously with hindsight, it looks like, oh, dang, that would have been a sweet catch. Yes. But if you are a swing trader or you're a trader that likes to implement mega trades into your model, which I think all traders should, because imagine catching a trade that pays you back so much time, Imagine catching a trade that makes you a lot more money and you paid time back. You're paying yourself back by making those mega trades. You don't pay yourself back making those short-term trades. The more money you make, the more time you essentially get back. That's what we're doing. We're trading our time for money. That's the world we live in. We're trading our time for money. So the more money you make, the more time you basically kind of got back, even though you're not getting that time back. But now you have freedom of what? Not stressing to probably pay bills. You have advancements in mortgage payments, advancement in car payments, advancement of all these other credit card payments. You have a lot of funds ahead of you. So now you don't have to work as hard. So now you pay yourself back. You probably don't have to, maybe quit your 9 to 5. Possibly. That's the end goal for all traders, possibly. But you see the mega trade takes off. But why? Because of the interest rate differential. It is so dramatic. This is the world reserve currency versus the yen in a negative rate. Of course they're going to take advantage of this, man. It's a no-brainer. It's a no-brainer. And then we'll see this also affected in other currencies as well. Let's look at, AJ. It's positive. Positive. Negative. Let's go to AJ briefly. $20.16. This is good enough. 2016. We don't see an immediate effect in it. But as soon as the banks start increasing their rates again, because like I said, Aussie, not a reserve currency, but it is a well-renowned currency. COVID hits. What happens? They start printing money. They start increasing their rates. Japan keeps negative. You think people are grabbing yen? No. Why would they? Doesn't make sense logically from a business perspective. Rate of return, ROI. Long term, Aussie will probably pay you more because of its rate. Its rate is positive. Yen is not going to pay you back. If you're holding yen, you have a negative rate of return. What investor wants a negative rate of return on their money? You want to lose money? You want to lose time? No, you don't. What happens? The Aussie starts raising rates during COVID and lockdowns and they start printing money. Boom. Shoots up. Shoots up. I think I have NJ down here too. NJ, same thing. The New Zealand dollar starts raising their rates. Look at you New Zealand dollar. Right? The central bank starts raising rates. It's positive. There's a difference. Starts running up. What else do we have? CAD. What do I have on here? EJ. Oh, we did EJ. No, I didn't do EJ. EJ, same thing. Look at 2016. Look how it makes that low in 2016. Look at that low. And they take advantage of it. Ever since then, look at where it is. All the way up here. Runs high. Higher yields bring in high ticket investors. They want money. They don't want chump change. They're thinking long term. You think these central bank traders are thinking short term? You think they're thinking about the next intraday trade? You think they're thinking about the next intraday trade? These central bank traders, you think they're talking about tomorrow's trade? No. They're talking about the next 2 months, the next 3 months, the next 5 years. They're talking about that. But we, like I said, we happen to be in the caste system, the working class, the less unfortunate. People that don't work in the central bank, that don't get those high-paying jobs, that don't get those bonuses or CEO bonuses. What happens? We have to hedge into this market properly. We have to get in properly. We can't just get into the market at any point and buy. Because a hard pullback on us would be deep drawdown. Which is why which is why you see a lot more retail traders focus on intraday profits. They need money now to pay bills. Right now. I need to pay my mortgage next month. I need to pay my gas bill. I need to pay my light bill. That's what you're seeing here with a lot of retail traders. That's why you hear everybody say, "Oh, I'm a scalper," but they're poor at scalping. You hardly hear anybody tell them. You don't hear enough people in the trading community. Me personally, you don't hear a lot of people saying they're a position trader or they're a swing trader. And I'm not here trying to force anybody to say, "Yo, you need to jump into position trading or swing trading." You don't have to do that. But I know long-term wealth is definitely generated through long periods of holding and long-term setups. You're just making a quick buck when you're taking short-term trades. Yes, you may get in with high risk, or you may get in with a high lot size and you're risking a lot. Yes, but is that sustainable? Probably not. But if you get in with a good risk parameter and you hold for the next 3 years and you find a good bottom or a good swing low and you hold for 3 months, 4 months, it would pay you forward. And you didn't have to take much risk compared to those scalpers that are getting in risking 5% on 5 positions. And then the market turns around on them and they blow the account. And then they're crying back in the forums again. I blew my account. End this cycle of depression and end this cycle of blowing accounts. Just gamblers. You go on YouTube and see a lot of gamblers. And people think it's funny, but it's really sad. It's sad to see it. People gamble their life funds away, their full savings account. You'll see a lot of examples. People rage quit. People punch their computer, throw their phone. They're on live streams. They're upset. They just gamble this money away. What else do we have? I wouldn't do Swiss yen, but I'll show Swiss yen just to see what it looks like. Oh my gosh. Look at this super bullish cycle, man. Look at that. Look at that. And this is all based off of macroeconomics, not even price action. Anybody could have told you, wow, all these other currencies are going to beat yen in the long term if they keep their rates negative. And guess, sure or not, time came to fruition, and every other currency right now is outbeating yen, outpacing yen. We even look at the yen futures contract. Let's look at the yen's futures contract. Right now, it's up. Look at 20. Look at where. Look at 2016. Look at that dump off. Look at 2016. It looks inverse to what UJ was doing, right? UJ made that huge fair value gap up, and then it slowly came into it. Look at what it did here for the futures contract. Look at that. Same thing. They started dumping yen. They said, yo, get this currency out of here. It's crap. I don't need this. Look at the speed on the monthly chart. Speed. And it's probably one of the largest candles during that year as well. 2016. Boom. And even in future years as well, this candle still is the precedented largest candle in the future years as well. See, it's a large range cycle. Look at all these tiny monthly candles. Yes, there are some large to small cycles going on in here, but compared to this large candle here, look at how small these candles are to this. Small. Until we finally start picking up and get these large candles like this, like this, like this, like this. Is this probably just a pullback, right? To go lower? Potentially. Because we know the market needs to probably make a retracement. Probably needs to mitigate some type of area that is inefficient. The algorithm doesn't like that. Or is there talks about the Fed's probably stopping rates or decreasing rates? And people are like, dollar's probably being unappreciated again or being depreciated again. Maybe we should probably grab a little bit of yen again. Yen might come back to life. Or is there talks about yen increasing their rates to finally back positive? We don't know. But when those rate decisions occur, I'm telling you, it plays a role in long-term trading and where these currencies are going to be. In the next 20 years, I'm going to be 40 years old. And I'm telling you, the same thing is going to happen. Unless they bust out the central bank digital currencies and they make it a one world reserve currency. That's a whole nother story. But if we were to have currencies long-term in the next 40, 50 years, and we still were carrying on this monetary policy of these fiat currencies, the interest rates will tell you exactly where the currencies are going to be long term. And you'll be able to find mega trade setups and you'll be able to find trending environments easier. That's it. This is why I'm telling you macro perspective is important. It's more than just a price action. It's more than just, candlestick patterns, harmonic patterns. It's not that. Stop letting people fool you that it's not smart money logic, SMC. What's SMC? No such thing as SMC. It's investors. These are investors. If I guarantee you, if I were to have an interview with a central bank or interbank trader, and I tell them, "Yo, do you use smart money concepts?" They're gonna look at me like, "What is that?" I'm telling you, they're gonna tell me, "What is smart money concepts?" It's only been a facade because of ICT coming out and showing us and exposing us to how the markets move. It's an ideology. That's all ICT has exposed us to. A marketplace ideology and a way for us to understand how it moves. But that's not what these central banks are doing. That's not what they're looking at on the charts. But that's all I have to say about the interest rate differentials. You could dive a little deeper on it. ICT has about 3 videos on it. Almost all of them are like 3 hours long. I wouldn't skip anything because he talks from real game about it. And Larry Williams, too, talks real game on this stuff, too. Larry Williams has a YouTube channel as well. His YouTube channel name is I Really Trade. I find that hilarious because he really does trade. He's a good trader. But this is one thing I want to leave you guys off with before I get into questions. Gold. So we're going to first look at AUUSD. And I appreciate you guys for sticking here and jumping onto another topic. So let me just check. One person in chat. Real spill. Facts. This is real game. This is real game. Nobody's talking about this except for probably informed traders, of course. And you guys are now informed traders because you know it now. You're not uninformed. You are retail, but you're informed retail traders. That's what I like to say. Gold. Oh my gosh, gold back to 2K. So we can see gold's making a comeback. Strong again. Strong again. But look at the, excuse me, look at the overall progression of gold. Look at this chart. This is the monthly chart. Gold has been outpacing because this is Mother's Nature's money. What we trade with and what we have in our wallets is currency. There's a big difference. There's a big difference between this. What we're walking around with, everybody in all their countries, that's currency notes. That's not money. There's a difference. Money is something that can never be created by man. It's impossible. Currency can be made by man. That's the biggest difference. Gold is money. The $100 in my wallet, that's not money. That's a paper note. It's a paper note. It's a piece of paper. That's not money. So there's a big difference when people say, "Oh, I got a lot of money." No, you have a lot of currency. That's technically what you have. You have a lot of currency notes in your wallet. You have a plastic credit card and debt in your wallet. That's what you have. You don't have real money. You're not walking around with gold coins or silver coins or copper coins. You're not walking around with that. You're walking around with currency paper. Nonsense. You can see gold outpaces almost everything. Now, yes, there are times where dollar and gold go up together. It happens. It happens. Because one, like I said, I bring it back to this. US dollar is the reserve currency. So it's always going to be the safe haven. Unless all falls out. But I know when the end, let's say hypothetically tomorrow was the end of the world, US dollar will be shooting to the moon. I know it. I know it. If the world was to end tomorrow, right? If things in the world were to get really bad, I'm not going to call and foresee anything, but let's say tomorrow was the end of the world, and we were to look, we had the chance to look at US dollar one more time before we leave this planet, I guarantee you US dollar was hitting high records that day. Because everybody was trying to buy the world reserves currency. And you know who else is going to be high up there as well? Gold. Gold and silver. And copper as well. But mainly gold. Gold and dollar will be the only two things that will stand last if the world were to end tomorrow. I promise you. All the other currencies that people have will go to nothing. Will go to zero. British pound, euro, yen, yuan, Swiss dollar, Swiss franc, Aussie dollar, New Zealand dollar, Mexican peso, all those currencies, Zimbabwe dollar, all that stuff will go to zero if tomorrow was the end of the world. And dollar and gold will shoot to all-time records because that is how it is systematic. There's no way around that. Gold outpacing everything, time after time and time again. This is why they keep telling people buy gold. Because if one day, theoretically, hypothetically, if we were to actually go back to real money, it's going to be valuable. Nothing can replace Mother Nature's real money. Let's take a look at the other pairs. This is gold versus US dollar. So the US dollar is the quoted currency. The base currency is gold. Let's look at gold. I'm going to look at the yearly chart too. This is going to be incredible. Imagine just buying gold. But nobody thinks about this. Nobody thinks about these things. Why not just buy gold and hold? Nobody wants to think about that. No, I'm a short-term trader. I'm not here to convince you though, but I'm here to speak common sense into people and inform the trading community. Because clearly these other channels aren't doing it. Gold outperforming many currencies year after year. Look at that cycle, man. Look at that bullish cycle. Wow. You would have been really profitable if you brought gold and held. Even on its downfall, yes, it pulled back. Yes, it pulled back. Fair value gap, yeah, whatever you want to call it. Whatever lower time frame, PD raise, yes. But eventually, what is a pullback eventually? Just another opportunity for you to invest. Right? You invest at lower prices, so you're buying cheaper. You're not buying at the high again because people are taking profit. Price pulls back. New opportunity to probably buy gold again. Gold does what? Runs up. And you can even see, time and time again, this natural cycle. Small range, large range, and counter trend candles. Down close candle, what happens the next month? Oh, the next year. This is 2018. The next year, bullish takes off. You clearly had 2020 vision almost, knowing when you should be buying after the down close candles. If gold is going to be here for the end of time, anytime you get a year down, you need to be investing. No, I'm not a financial advisor. Consult your financial advisor. Disclaimer, because I don't want nobody suing me. Price coming down is your new opportunity to go long. If you know gold is going to be a currency, currency. Let me never say that again. If gold is going to be real money, you know the down years are just new years for you to get into the market. That's it. That's all it is. And time again, your rate of return always paid you forward. Because from 1998, let's say I was born 1998. I'm 24 years old. Let's say my parents invested in gold in 1998, the day I was born. I don't know what they might have invested, but whatever they might have invested, whether it was $1, whether it was $100, $100,000, 10 grand, 50 grand, 2 cents, I know the rate of return was positive because look at where gold is. Common sense. Let's move on. That's gold versus the US dollar. Now let's look at it versus the other currencies. It's smoking all the other currencies. This is what you know. All these other currencies are trash. Not to say, I know some of you guys live in other parts of the world. I'm not saying that your country is trash. Some of you guys live in the most beautiful places in the world that I wish I lived in too. But look at this. Gold versus the euro dollar. Oh, man, I laugh when I see this, man. Hard pullback back into a fair value gap. If we were to use ICT concepts and use PD arrays, pull back into this fair value gap right here, and price runs higher. Wow. Look at that rate of return. Rate of return over and over again. Gold outpacing fiat currency once again because it is real money. And everybody knows it. The poor people don't know it, though. The uninformed people don't know it, though. The middle class doesn't know it, though. The upper class, the rich, the millionaires, the billionaires, I guarantee if you talk to a lot of these CFOs and CEOs, a lot of them probably have a good stake in gold, a good position in gold, and have been holding for quite some time. And they've seen only nothing but profits in green. Yeah, they may have years that might come down, but they know that's just another opportunity for them to invest. Let's take another look at something else. This is gold versus, let's throw out another currency, Aussie dollar. Smoking every currency. I keep trying to tell people this every time. It's the easiest thing to see. Stop making trading hard. Stop making trading hard. There are some things in this market that are just clear, cut, clean, and easy setups. You know it's there because it's sound logic. What I'm showing you is logic. And most financial institutions will tell you, please have some type of investment in gold. Right? Anybody that's managing someone's portfolio is going to say, okay, you can allocate, you need to allocate some of your equity to probably 5% gold in your stock portfolio. Because they know gold will outperform. They know it's one of those things that perform time and time again, year after year after year after year. Okay, TradingView started tracking it in 2006. I know there's probably more data before it, but TradingView started tracking it in 2006, unless I have to pay for more data. But you can see in 2006, you can see it keeps going up. And after every down year, what happens? Take off every time. Another one. Let's go gold Swissy, just cause. Come on, guys. You guys see the pattern here? Hopefully people watch this video to the end to see this. This is a gem. CAD. I'm throwing in any currency. We don't care what currency it is. Doesn't matter the currency because it's getting smoked. It's getting cooked. It's getting cooked by real money. What else? New Zealand dollar. Cooked. Everything's getting cooked. Look at that. It's the yearly candle, by the way. These are the yearly candles. What we got? Smoked. Doesn't matter what currency I put up here, bro. It's going to outpace those currencies. That fiat paper currency they keep printing at your central banks every single day and keep telling you, yeah, keep collecting this money. It's not money. It's not money. This is money. The chart is even telling you that this is real money because look at the rate of return. It's not doing like this. This magnet. It's not doing like what the other currency pairs are doing, like this. No. This is real money. So it's going to do this. It's real money. It's not currency. It's not dollar versus yen. It's not UCAD. It's not EJ versus pound. No. It's not Swissy versus yen. It's not none of those paper fiat currencies or those currency pairs that we're trading. That's why you're seeing real money, rate of return, time after time, progress over fiat currency. This is gems. I really hope people watch to the end. I know this is a long video, and I can talk, and I love this stuff. I just love talking about this stuff. Doesn't matter what current. Like, let's see. Do we even have gold Bitcoin? That's wow. I never actually watched gold Bitcoin. Wow, that's actually really interesting. It's my first time looking at this. It's interesting. It's down against Bitcoin. That's really interesting. Calculated by TradingView. Huh. Wow. I've got some research to do. This is interesting. That is really interesting, man. That is. Hold up. I gotta take a little chart picture of that. What? Definitely gotta hit Jules up about this. Hit the chat up. What is up? Wow. Is Bitcoin outpacing gold? Yo, this is interesting. But back to the currencies. I have to do my research on that. Last one. Let me just think. We got CAD. We do CAD? I think we did CAD. Oh, we did it. I think we did CAD. I could have been doing the same thing. But look, same thing. Year after 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 year. Gold keeps making new highs, new record highs. It's not making new record lows. Gold is not making new record lows. When would gold ever make new record lows? It would have to come all the way back down here. You think they're gonna dump gold? Never. Never. They're gonna hold gold to the end of the world. Till this earth collapses. Whatever the case may be. You know? Not saying I want the earth to collapse. I would love the earth to stay in pieces and everything be in harmony. But if the earth were to hypothetically come to an end, gold is gonna be the last real money on this planet. And that's it for today, guys. Hopefully this is insightful. It's Forensic Forex. Your boy Deontay, once again. Forensic Forex, man. It's an interesting name. I wonder why I picked that name. Yeah, I know. It's crazy. Gold has been outpacing everything. Nobody thinks about this stuff. At least, like I said, caste system. People that are informed about finances or people that are informed about money and the way the world works, they look at these things. This is important. Really important. Any other questions I didn't answer? If you have any questions, just shout it out. Don't be afraid. Hey, nice. I'm glad someone Andrew, thank you for answering Alex's question. Yes. The indicator is FXN. Yep. 100%. I'll even show it here. Right there. FXN. Right there. Man, it's been a pleasure, guys. Hopefully you guys found this insightful. Peace, man. If anybody has any questions, shout it out. I'm going to sit here for a couple minutes. If you don't, then it's all good. Enjoy your weekend. Safe trading. Enjoy your loved ones' time and company. Time is our real money. That's it. Time is our money. But we're trading it for paper currency. Whew, what a world we live in, man. I think everybody's set. All right, cool. All right. It's been nice. If you do want to reach out to me, I will be available on Sunday. Tomorrow, I will be back testing with my group. And I appreciate it, man. Shout out to everybody that was here that watched this, man. Got to get this knowledge in, man. I'm telling you, it's important. Life is no joke. Life is no joke. You got one life. Make it count.